Hello, everyone. Thank you for joining us today for this special online event from the Oxford Guild. We are bringing this to you in conjunction with our Collegium Global Network and partner societies at different universities, including Warwick, UCL, LSE, among others. We are delighted today to be hosting Danielle DiMartino Booth for a very topical and exciting talk on the global economy in a COVID-19 world. Danielle is the CEO and chief strategist of Quill Intelligence, a research and analytics firm. Previously, she served 9 years at the Federal Reserve Bank of Dallas, where she was chief advisor and Wall Street liaison to President Richard Fisher throughout the financial crisis. She is the author of Fed Up, an insider's take on why the Federal Reserve is bad for America, and is a sought-after thought leader for her insights on the financial world, appearing regularly on Bloomberg, CNBC, and Fox News, among others. Thank you very much, Danielle, for joining us today. Over to you.
Greetings, salutations from across the ocean. Great to be with you today. I think that it's very difficult to have the discussion about the role that central bankers have played in the run-up to COVID-19 without going and getting a little bit of background. I will tell a story of kind of where this all began very quickly. And I think we can all relate now that we've actually seen what stock market crashes look like. I think we can all relate to possibly a little bit better what happened on October the 19th, 1987. Alan Greenspan, who was a rookie in his position as the Federal Reserve Chair, had boarded a plane to make a presentation to a prestigious economics conference that next morning in Dallas, Texas, where I live, where I am right now. And when he landed from DC, he was handed one of these old brick phones that you would see Michael Douglas walking down the beach carrying, and a very harried Dallas Federal Reserve staffer threw the phone at him. Somebody in DC was saying, "We've had the Standard & Poor's 500 crash by 23.4% while you were in the air, sir. Obviously the largest decline in U.S. history in one single day on a percentage basis." Greenspan never made the podium that next morning. He boarded a plane, flew right back to Washington, D.C., and he put a statement out that said the United States Federal Reserve Bank, in its capacity as the nation's central banker, is here to effectively ensure the stability of the banking and financial systems. He was not kidding. He was not exaggerating. In the weeks and the months that followed, the New York Federal Reserve, which handles all the open market operations, is the liaison between Federal Reserve policy and the actual Wall Street, where it is taken out. Alan Greenspan sanctioned the New York Fed, providing Wall Street bond trading desks with information prior to Fed injections of liquidity into the system. So pick up the phone, call Merrill Lynch at the time and say, "We're about to inject X billions of dollars of liquidity into the system," effectively giving bond traders license to front run the Fed, to profit from Fed moves prior to the central bank coming into the market. That is where the Federal Reserve put, as we call it, that's the day that it was born, October the 20th, 1987. Alan Greenspan had an obsession, this came out in his biography, an obsession with the stock market, and that became very unhealthy. It created an adverse feedback loop in time, because once you establish that the Fed is going to cover investors' losses, once you take the risk-reward equation and monkey with it by backstopping investor losses, you start to kind of destroy the ability of markets to determine prices, and you introduce moral hazard into the system. As the years progressed, 1998, long-term capital management, a hedge fund threatened to blow up the financial system, unleash systemic risk. The Fed came riding to the rescue. There were obviously 2001, there was a tequila crisis in Mexico, 1994. Since 1987, the Federal Reserve has come in and ensured that there was ample liquidity in the markets. What you're looking at on this first slide is if you will, the ammunition that the Fed has to use, which is debt. At the financial crisis, at the advent of the financial crisis, the Federal Reserve took interest rates down to the zero bound. And taking a book out of the playbook of the Bank of Japan, decided that it needed to, I was inside the Fed at the time, that it needed to start at synthetically creating easing so that it could get past the barrier of the zero bound and try and encourage more and more lending. In order to do that, it started to buy up US Treasuries, buy up mortgage-backed securities in the open market, grow its balance sheet, print money. In the aftermath of the financial crisis, because it was a global recession in nature, this kind of took off like wildfire. Every central bank in the world took up the same methodology. The Bank of England, obviously, the European Central Bank, gave new meaning to growing its balance sheet. I believe the ECB's balance sheet today is approaching 50% of EU GDP. And as a result of all of this liquidity making its way into the system, we had greater and greater and greater amounts of debt being created. The Institute for International Finance announced a few days ago that global debt in the first quarter of 2020 now tops $325 trillion, whereas we saw the buildup leading up to the financial crisis in the household debt arena. This time we've seen it more in that first category of non-financial corporate debt. So whereas it was a housing bubble, household finance driven bubble a decade ago, 12 years ago, this time it's been corporate debt that has been really the engine of building up liquidity and instability in the system, as we've seen play out. The question I'm asked the most often now, because after 1987, the Fed was lower for longer. After 2001, the Fed was lower for longer yet in order to inflate the housing bubble. After the financial crisis, the Fed was lower for even longer, and it blew up its balance sheet with quantitative easing. Now the question is posed, can Fed liquidity address insolvency? Because from everything that we can see, that appears to be the modus operandi. That appears to be what is factoring into Jay Powell's thinking. I took a poll on Twitter, very much back of the envelope, if you will. 79% said no, the Fed cannot address insolvency with liquidity. 21% said yes. But the fact is, what we've witnessed in financial markets is the fact that the Fed can postpone insolvency. So where were we pre-COVID? Because it's imperative to have a backdrop. The not QE, whatever the Fed was calling it in 2019, blowing up its balance sheet, but not calling it quantitative easing because it wanted for it to be technical in nature, even as world trade was sliding into net negative for the year, which has only ever coincided with global recessions. So the Fed knew that the global economy was slowing. It knew that the Chinese economy was slowing. It knew that Germany, the engine of factory growth, was slowing. So it was pumping more liquidity into the system since any other time since 1969. That's a backdrop. It also is something that creates tremendous instability. Where did this liquidity go? Again, it brings us to the corporate debt market in America. This is math that Morgan Stanley did in December 2019. And what it shows is in a similar vein to what occurred at U.S. credit rating agencies leading up to the subprime mortgage crisis, the financial crisis, by giving the AAA stamp of approval to subprime mortgages, many more investors were able to own them that otherwise should not have been able to take on that kind of risk. If you want to draw a parallel to what we've seen over the past 12 years or so, the credit rating agencies have been giving what should be junk rated, high yield and speculative grade corporate debt. They've been giving them the stamp of investment grade approval, even though according to Morgan Stanley's math, 42% of the US investment grade bond market should have been rated junk. So again, this is a pre-COVID snapshot On February the 21st, this is 2 days after the U.S. stock market peaked, the U.S. bond market crossed the $10 trillion threshold, more than a doubling in the space of the prior cycle. 3.4 trillion of that is what we would consider to be true high-grade bonds, something that your grandmother could own, and you can sleep well at night knowing that it's going to be money good, that the principal is going to be returned upon maturity. And then there's this $3.3 trillion slice of what we call BBB rated debt, and that is one rung right on the edge of junk. And that was the vast preponderance of what Morgan Stanley had said should have been rated junk had the credit rating agencies not been inflating their ratings. In addition to this, we have leveraged loans. Leveraged loans have hit Europe, but we have a $1.3 trillion leveraged loan market that surpassed the size of the junk bond market, the high yield bond market at $1.2 trillion at the end of the year in 2019, and kept growing. And then we have about $1 trillion private credit market. Think of this as even riskier paper. So just to think proportionately, $3.4 trillion of what is truly investment grade is dwarfed by the $6.6 trillion that we had in high risk debt. That is the problem that the Federal Reserve encountered when COVID-19 hit, is you have effectively this massive ticking time bomb of debt that is effectively insolvent and could potentially unleash systemic risk. Over in the bottom corner, as you see, the Fed made an announcement on March the 23rd that has since reversed risky asset markets worldwide, saying that they would come out and buy any investment grade debt that had been downgraded after March the 22nd, that they would still be able to buy that using a special purpose vehicle sitting on the balance sheet of the U.S. Treasury Department, because it's illegal for the Fed to actually be in these markets according to the 1913 Federal Reserve Act. So I'm trying to communicate that the Fed is really playing with fire here with some of the policies that they've rolled out. You also have to bear in mind, in terms of thinking about what central banks' capacity is to stimulate economies, to prevent a recession from becoming a depression, you have to also bear in mind what the Fed is offsetting. When you hear about a corporate credit crisis in America, you would naturally come to the conclusion that chief financial officers are no longer going to be in the business of buying back their shares. They're going to have to tend to their balance sheets going forward. That is exactly what we have seen. But if you add up all of the net buyers, whether it be mutual funds, exchange traded funds, private pensions, public pensions, individual investors throughout the last cycle, they were actually net sellers of U.S. stocks. They were more than offset by the net buyer, which was corporate America. Why were they buying back up to $1 trillion in 2019 of their own shares? And that gets to U.S. law that was changed in 1982 that allowed corporations to buy back their shares. Earnings per share is what determines executives' compensation. So the fewer shares you have out in the public market trading, the higher mathematically your earnings are. Estimates suggest that earnings were 50% inflated since March of 2009, when markets last bottomed, by this process of share buybacks. Again, though, that is largely going to disappear as we've just come out of earnings season, and the Fed will have to provide a massive offset in order to keep the stock market elevated. They have to offset what companies are no longer doing. Let's look quickly to the American consumer. We're putting stimulus into the economy, the likes of which we've never seen. National debt should probably hit $30 trillion by the end of the year. And the reason we're having to be as aggressive as we are is the red line on this chart. It shows the bottom quintile of earners in America. In Great Britain, you've had similar levels of acute housing inaffordability, whether you're talking about renting or buying. So I'm sure you can associate with what this represents. But if you add up what the lowest quintile of earners in America was spending on rent and healthcare alone, that had increased from 42% in 2004 to over 55% of their take-home income. Obviously, such a dynamic becomes very problematic when you have 28% of Americans who have applied for unemployment insurance so far. That is through this morning's data. That's all. We're talking about almost 1 in 3 Americans, and this is prior to the second wave of layoffs that we're anticipating coming through the system. So that is where Americans were coming into COVID. You had the haves, you had the have-nots, the inequality divide, all of the things that are international phenomena were writ large in the United States, accidents waiting to happen, and help explain again why the amount of stimulus that had to be put out and still is required is so essential, because we do have the chance that we see mass evictions, mass foreclosures, mass repossessions of vehicles, etc. In addition, you have China. China staring down a 60-year jinx. Obviously, British historians know of the 60 years. Every 60 years, something very bad happens. In China, 2020 happens to be that 60-year anniversary. But prior to COVID, we had China slowing to a 30-year low. We had a trade war break out. And as you can see, the disruption in the supply chain, 24% of US auto supplies came from China. Depending on the width of the arrow that you see on the screen, you see how very critical just in one massive industry of auto parts, China had become to the supply chain. If you back this out, obviously, to pharmaceuticals, some of the other industries that have become acutely undersupplied in this COVID crisis, you see how problematic it had become to have as much reliance as we did on a global level to one country and one country's output that is not necessarily a true ally, if you will. We can talk a little bit more. I know there's some questions about China, but you have to understand that in addition to household sectors around the world being hobbled by over-indebtedness, the corporate sector being way over-leveraged, much too much debt, and this is not just obviously an American problem. Think about countries like Turkey. But then you also have this impetus to deglobalize, and what the implications might be for inflation and deflation as people look to move the supply chain and move their reliance away from China. Again, these are going to be things that have to be offset in some way, shape, or form by stimulus, whether it be fiscal or monetary in nature. The problem with central banks' strategy of creating debt in order to generate gross domestic product is the law of diminishing returns sets in. This is some great work that was done by Hoisington Asset Management. Google them. They're wonderful. Put out a wonderful quarterly letter that you can read for free. But if you look at the Eurozone, if you look at Japan, if you look at China, the difference in terms of the bang for the buck, if you will, the bang for the pound. Do you say that in England? Anyways, but the difference between what you got in 2009 and what you got in 2019 for every dollar of debt that was generated had come down appreciably in the aggregate globally by 11%. In the Euro area by 13%, in Japan, obviously more by almost 15%. Again, those with more debt, those with more central banking balance sheet growth see less and less and less return for every dollar they generate, with China, which is pumping record levels of stimulus into its economy right now, the most hampered. The law of diminishing return dictates that they had a near 40% loss of the efficacy of every dollar of debt that was created to generate that dollar of GDP. I'll throw this last one out there. I'd be interested in your feedback. You email me later as to whether inversions necessarily preceded recessions in the UK, in the United States, in the post-1950 era. That has certainly always been the case. And if you have overinflated risky asset prices, as was the case in July 2000 when we had the NASDAQ, the internet bubble, you tend to have less time in between the first date of inversion, the first day on the calendar that the 3-month yield on the Treasury curve trades above that of the 10-year benchmark Treasury. On average, you've got 11 months before you slide into recession. But if you have risky asset prices, then you're going to be setting yourself up, if you will, for a greater degree of instability once any type of event occurs. In this case, we have an event that's the worst in 100 years that has hobbled central bankers and political fiscal authorities worldwide. So that is kind of where we are now. And
thank you so much, Danielle. We have a few questions coming through, and the first one is from Sonia, who's doing mathematics at UCL, and she asks, is the UBI economically viable in a post-COVID world?
So universal basic income is a really red hot topic. Andrew Yang has become a minor celebrity here in the United States, even though he's no longer in the running for the presidential campaign. This is something that we're seeing play out in real time. There's a reason that Bernie Sanders dropped out of the election. The United States right now is effectively putting a form of UBI light into the economy. The average working American who's collecting unemployment insurance today, because they're collecting an additional $600 per week on top of what they would normally get via unemployment insurance, they're making more. They will make more in the second quarter of 2020 than they would have made had they stayed in their job. In addition to that, we've put actual stimulus dollars out into the economy, and there is discussion of more helicopter money, if you will. I am of the personal philosophy, though, and again, we're seeing this play out in real time. People who are being given the opportunity as states on an individual basis reopen, people who are being given an opportunity to come back to work don't want to. They know that they'll continue to make more money and that unemployment insurance should be extended to 39 weeks, which takes you into Christmas of 2020. They know that they'll continue to make more money. And the risk inherent in UBI is always going to be that you'll end up with a sclerotic labor force because people won't want to work for lower wages than what they could make otherwise. So these are the risks. And again, we're seeing them play out in real time. Jay Powell has been very public. He was on a big news show here Sunday night called 60 Minutes. He was in front of Congress testifying a few days ago and has been very open about saying, if Congress prints the money, if Congress passes the legislation, the Federal Reserve will print the money in order to facilitate whatever stimulus comes down the pipeline until the economy is on a more stable footing. But the risk is that you get universal basic income and a disincentive for there to be a return to the workforce such that you get caught in a trap of sorts that ends up looking a lot like socialism. So that would be the risk, if you will, of UBI. Can central banks facilitate it? Absolutely. Is it an economic solution? I don't think so.
It'll be interesting to see how that plays out. The second question we have is from Casper Whiffen, who's doing history at Oxford, and he asks, what are your thoughts on the WHO's role in the crisis?
So this has become a very economic event. COVID is a humanitarian. It's a healthcare crisis. We're seeing it play out tragically in places where urban density, such as Brazil, such as India, where urban density is a huge issue. And it is a humanitarian crisis, but it is also becoming an economic crisis. And there was something to be said in the very beginning for all of the reports that were coming out that the WHO was going to gain admittance to Wuhan, but somehow never was. And so all we know from the scientific community, from the perspective of the scientific community, all we know is what we don't know about COVID, because the World Health Organization was never allowed entrance into Wuhan. They were never allowed to go fact check and see if the statistics that were coming out of China were correct. We do know that in a city of similar density, such as New York and size, 11 million, that the rates of infection and the number of deaths are that much higher. So I've been very much on the record publicly, and I'm advocating for what our peers in Australia are advocating for, along with 116 other countries, for there to be an independent inquiry into the origins of the coronavirus. I find it to be somewhat ironic, however, that this is going to be in a World Health Organization forum, virtually done come Monday. But I do think that the role of the World Health Organization does need to be questioned, because there should not be any country in the world in which they're not allowed to be admitted in the middle of something of this magnitude that has caused this much human and economic devastation.
Vikram, who's doing classics at Cambridge, also would like to know, as a founder of a successful research firm, what would be your main criticism of economic research on the impact of coronavirus?
So what we're studying right now the most closely is central banking efficacy and what the ripple effects are going to be in the economy, because we've seen this phenomena of time compression. Everything that normally takes a long time to play out in economic cycles is happening very quickly. It's as if somebody has speeded up the hands of time. And so we're studying the effects of economic shocks on systems and response times to them. Obviously, we've seen some countries respond much more slowly. The Federal Reserve has been going lightning fast. But again, whether or not there are going to be limitations to central banking stimulus, those are the things we're focusing on the most. We're focusing on the second wave of layoffs that we're anticipating coming, because the expediting of the death of brick and mortar retail is what it is. There are going to be people permanently displaced because of this. And again, the idea is you can print a lot, but you cannot print jobs. And that is going to be the focal point of having an exogenous shock of this magnitude hit the biggest economy in the world, what the ripple effects are going to be and what the implications are for our long-term economic prospects. That's what Quill Intelligence, my research firm, is most focused on right now.
On the topic of central banking, we have another question related to that. Antonia, who's doing MBA at Oxford, asks, is the Fed an overly politicized institution? Should the power to nominate its chair be withdrawn from the executive branch?
So I think that Federal Reserve independence is something that, as I said early on, was compromised starting with Alan Greenspan, because the Federal Reserve has the power that it has, and because of how our political structure is laid out. We've got the Supreme Court, Congress, the executive branch. I would argue that the Federal Reserve is just as powerful, in other words, a fourth branch of power, such that it should not come out of the executive branch who is appointed, that we should indeed have to have more independence in terms of the people who are appointed. And I can just about guarantee you that we would have a different makeup of the Federal Reserve Board. We would have a different makeup of the Federal Open Market Committee had it not been driven by political selections. So yes, I do think that is something that should be considered, especially in the current crisis, because there now is mixture between Federal Reserve policy and fiscal policy because of some of the liquidity programs that have been set up to purchase corporate bonds. So now you've got a total entanglement between the political branch and the monetary branch that was never intended in the 1913 original act, such that I think once the dust settles on this crisis, it should be a matter for Congress to take up and look at how to reestablish true independence at the Federal Reserve.
Central banking seems to be quite popular, so we have another one from Jamila, who's doing economics at the LSE. She asks, what will negative interest rates mean for America? Has the Fed learned from the mistakes of the Bank of Japan, or is it just repeating them?
So this is where I talk out of the other side of my mouth. if you listen to most Federal Reserve officials, it's typically like herding cats. They've all got different opinions, different viewpoints. But the one area that they agree on, and this has been very public in recent speeches that have been made, and again, Chairman Powell's had 3 consecutive public appearances just in the past few days. The one area they agree on is that negative interest rates will not work in the United States. We have a different financial system infrastructure. We have a $5 trillion money market fund industry. Just 2 days ago, we had a money market fund collapse. It broke the buck. Interest rates are already so low that it was untenable for that particular fund to stay in business. Other countries, also their banks, Japan, Europe, they use as a reference rate in the Black-Scholes model, for example, in any kind of an IRR calculation, instead of plugging in their negative interest rates that are prevailing in their own economies, which would blow up their models and provide either an undefined or an infinity as a product, they plug in US Treasury rates that are positive. So there has to be a positive reference rate somewhere on planet Earth, or a lot of the models that drive financial markets break down. There is a money market fund industry in the United States. And if you look at the Euro Stocks Index, or if you look at the banking stock index in Japan, you see that the banking industry has completely been slaughtered. And profitability has gone out the door. In the United States, I think banks would just shutter up and close, because there would be absolutely no incentive to lend in a negative interest rate environment, and because profitability would be slaughtered, which is reflected in European and Japanese banking stock prices. So I am happy that Jay Powell has held the line. I heard a great interview with Mervyn King this morning. He also said, at the margin, because the Bank of England is obviously very publicly debating this right now, he said at the margin, taking interest rates from 0.10 to negative 0.10, what is that going to do to generate economic activity if there's an underlying recession or if credit quality is being questioned? So I think that negative interest rates have been a failed policy. I think they've been a proven failed policy. And I hope that we don't get a new crop of central bankers in the United States who actually considers that to be an option. I hope we hold the line and don't go there.
Fascinating. If we hop on over to the other side of the pond, Leo, who's doing international management at Warwick, has asked, do you think governments of all countries could have adopted a similar strategy to the one in Sweden, with fewer restrictions and less economic damage?
Well, I think that this is going to be one of the most hotly debated questions out there. I prefer not to look at the Swedish model because we really don't know. If you look at Swedish data, it's terrible, even though they have not had the same restrictions. So we are in a global economy. That would be my first point. My second point, though, would be to look more to a model of South Korea and economies that knew what was coming, economies that had come through pandemics. Hong Kong is another great example. Hong Kong has had 4 deaths. And they really have not had to be as restrictive because they went through the disaster of SARS years ago and lost as many people as they did. What the most successful economies are teaching us is that you don't need any restrictions, but you need strict adherence to all of the social distancing, wearing of the masks, making sure that capacity in restaurants is only is limited. They opened up the Seoul nightclubs. I believe they're reopening Seoul bars and nightclubs again in the next few days. But they had the instance of the one young man who was in 5 bars and nightclubs in one night and infected 119 people. So it is clearly a very contagious disease, a very contagious virus. Excuse me. But if you look to the examples of countries that never really even had to shut down completely, but again, adhered to the strict standards of social distancing and using the masks, I think that should be the way that we look at this in the future. In the United States, the way it's going with reopening, very few people wearing masks, especially where I am here in Texas. It's hit or miss. There's no ubiquity to the standards, and that is going to prove problematic, because you can't control the spread of the infection, I think, if you don't have the right protection.
Speaking of the future, Alia, who's doing history and economics at Yale, asks, is Chinese financial dominance inevitable?
I just wrote 4,000 words on this and published this last night. My answer is, I don't think so. I don't think that it is. I think that there could be long-term economic ramifications because of the economic devastation for China. Global supply chains are moving. When you hear announcements such as the one from Apple that 25% of its AirPod production is going to be moving to Vietnam, when you see, again, 116 countries coming together backing Australia's calling for an independent inquiry, and Australia, by the way, 7.4% of its economy is export solely to China. If countries are willing to absorb tariffs, be economically penalized by China in order to get what they feel to be justice because of what's happened economically because of the coronavirus, I think that there is something to be said for China's potential to become economically dominant being questioned. Their debt is 317% of GDP. As we saw in one of the slides earlier, the efficacy, the ability that they have to generate economic growth is the worst in the world compared to the major nations. Their financial system is still largely closed, and the urbanization of the Chinese population has been somewhat exhausted in terms of the ability for them to come out of this 30-year low rut that they've hit. The wherewithal for Chinese authorities at this point, I think, to collect on some of the bad debts is going to be problematic. You've got the IMF, the World Bank looking into these matters and trying to provide a lot of these, the lowest income countries in the world that China has extended debt to. They're trying to provide relief to them at the same time. So China is going to have a lot of bad debts on its hands as well, which is going to throw a wrench into the Bridge and Road Initiative. So I think that there is the possibility one day that we see China become dominant, become the dominant world economy. If the United States was to lose reserve currency status, if U.S. debt was to continue to grow such that inflation became problematic, or worst case scenario, the world's regulators and central bankers and politicians were talking about a debt jubilee. I think if currency wars become hot wars, if geopolitical tensions rise, if something magnificently large happens such that the United States reserve currency status was in question, then I certainly think that the opportunity would present itself for China to become economically dominant. But again, it has hobbled itself because of not just the debt that it's taken on as a country, but the debt that it's extended as a global lender. And that's not something that they're going to be able to recover from very easily after this shock.
Casey, who's doing PP at Oxford, asks, do you expect the presidential elections in November to have an impact on the Fed's actions over the next 6 months?
No, I don't. I think that Jay Powell is so frightened of the possibility of the credit markets unraveling, which he's exemplified with a lot of the actions that he's taken. And he's been very open saying that interest rates are not going to rise anytime soon. And he's practically begging to print money for more stimulus. I think that whatever Congress legislates, the central bank will not be concerned about the stigma of Fed actions in an election year. That said, I think that the impediment we're going to see, and we're seeing it play out with the Republican Party in the United States now, because the Democrats have proposed sweeping, and the next iteration of sweeping stimulus measures. I think the problem is the closer you get to the presidential election in the States is that you're going to have Republicans and Democrats remiss to work with one another because they're not going to want to benefit each other at the polls. So you might not have enough for the central bank to do in terms of the money printing. But no, I don't think that politics applies right now to central banking policy as it would in a normal presidential election cycle.
Gaurav, who's doing an MBA at Oxford, asks, what is the threat to US dollar dominance in light of the ongoing COVID crisis and the US Treasury carry on printing vast amounts of dollar?
So again, it's been fairly illuminating. We've seen the Federal Reserve buying so much Treasury debt that foreign buyers of Treasuries, their purchases have crashed over the past few months. We've seen fresh data on that. And the key to the U.S. maintaining its reserve currency status is that other countries are always willing to step up to Treasury auctions. We're not Japan. We're not a country that solely owns our own debt. We are beholden to the kindness of strangers in order to finance Treasury debt. And if we were to push the envelope too far, if we were to say, so what, we've got almost $30 trillion of debt, let's make it 60, then I think you do run the risk of inflation and of countries stepping back and saying enough is enough. If you study history, Portugal, Spain, the United Kingdom, just because reserve currency status lasts for as long as it does, decades upon decades upon decades, does not mean that it's bulletproof. And there is the risk, the more we disregard the level of debts that we're running up, there is the risk of losing that reserve currency status. So I hope we don't go there. I hope that that cooler minds prevail and that we find some way of finding our way back to having a more disciplined approach to fiscal policy.
Speaking of debt, we have another question similar. Naveen, who is a Cambridge alumni and also working at Unilever, asks whether the CBO projects that the debt to GDP ratio will reach roughly 119% by 2050. Will it be possible to pay down this debt? Will it even be practical to pay down this debt?
Well, that's that is the $1 trillion question. That gets us back to what I addressed earlier, and whether or not it will be feasible to have a debt jubilee. And so that answers your question about whether it's practical to pay it down. Because once you get to a certain level, if you consider even the off-balance sheets debts in the United States, whether it be the Social Security system, the Medicare program, those aren't even imputed. That doesn't even come into the calculus of the 190% that's projected. At some point, it really will come to a debt jubilee because it won't be practical. Demographically, we're obviously not going to become an emerging nation with 6-7% growth rates. So at some point, there will be this risk that we have to come to the global community in order to add. And of course, it's not a United States centric problem, is it either? You don't have, it's not $325 trillion of United States debt. No, that's not the case. It's global debt. And that's why economists tend to get to the issue of whether or not there will be a debt jubilee in the future. I can't see reserve currency status being retained after such a drastic measure. And again, I've seen the CBO projections. I hope we don't go there.
We have a more general question from Tom, who is doing economics at Warwick. He asks, what do you believe lies ahead for the future of inflation?
Well, a lot of these questions are asking the same question in different forms. And again, I think that if you're talking about universal basic income, if you're talking about doubling of the US debt, at some point you can have pushback at Treasury auctions, even if you have sclerotic growth. You could have the worst of all situations. You could have stagflation. You could have rising interest rates in the face of slowing growth. And that would be the worst of all worlds. The idea that, and the one that Jay Powell espouses, that the central bank's balance sheet can be run up to infinity and beyond because inflation will never be an issue, is a very dangerous one. And that is something that we have to be cognizant of because we are part of the global economic community, and inflation could become problematic, and it could happen in the blink of an eye.
Stephen, who's doing finance at the LSE, asks, does MMT have the answer for the current malaise?
Well, modern monetary theory is an expansion of universal basic income. And that gets us again to a doubling of the debt. When Elizabeth Warren was still in the presidential campaign, I think one of the reasons that she ended up bowing out was because when she was asked how on earth MMT was going to be financed, because you're talking about upwards of $30-40 trillion of extra debt if you're talking about Medicare for all and universal basic income and paying for all college and universities, and obviously expunging all existing student debt. It's so much money that you're talking about that you could end up with inflation, and MMT's solution for inflation is not politically practicable in my mind. Instead of the lever of interest rates in order to control for price movements, inflation, deflation, you simply raise or lower the income tax rate. In a political world, I cannot see that as being practicable, that you're going to have Congress come together, hundreds of people, every time you have inflation perk up and say, okay, we need to raise taxes. So there are a lot of things about MMT that are appealing in theory, but I think they would not be politically practicable, to use that word again.
Anna, who's doing geography at UCL, asks, what could the CIA have done better to stop the crisis getting out of hand?
Well, I'm no expert in matters of international intelligence, but I can say this much, and it's just because none of us are experts, but we've all studied COVID, and that is that if the first documented case in Wuhan went back to November the 17th, I believe, it should have been known to our Central Intelligence Agency much sooner than it was, or at least we're not being told everything that we should have been told, because theoretically something doesn't run around for 2 months in a country even as closed as China and not somehow get on the intelligence radar screen. Of course, in the background, and I've done an extensive interview on this, in the background, there was the trade truce, the trade deal that was being negotiated, and the January the 15th signing of that deal. And from what we have been told, and again, you can only trust so much from the media, and you're certainly not going to have the CIA be completely open with you and say, we briefed the president on this day. But from what has been publicly released, the coronavirus was part of President Trump's international briefings at the very beginning of January. And I think that it's a bit far-fetched and naive to say that that's the first that he learned of it. But even if that was the case, he did go ahead and sign the trade deal on January the 15th, knowing well that China in September had asked for the unforeseen circumstances, force majeure type of clause, to be put into the trade agreement such that they would be able to go back to the negotiating table in the event of an unforeseen circumstance that would obviously include something like a global pandemic, and be able to back away from their obligations. And indeed, that is what they have triggered here in the past few days. So these are things that if our CIA was worth the salt, that they surely should have known about and been advising the president about long before the instance of the first actual reported case of the coronavirus in China.
Fascinating. Diana, doing medicine at Cambridge, asks, says, I know it's hard to make a prediction, but do you think Trump's presidency, so reliant throughout on its economic success, will be ended by this crisis?
Well, it's pretty easy to make the prediction, actually, because if you look at every single presidential year when you've had an increase of the magnitude that we have had in the unemployment rate, the incumbent is always voted out of office. So on paper, the prediction says 100% that Trump will lose. But the true answer is, I don't know. I don't know if this crisis is going to end Trump's presidency. The divisiveness in the United States is something that is very difficult to describe. You know, on a personal note, I am in a city that has been opened up for weeks, but because of the adamant pushback from so many people here in my community who will not wear masks because they're standing on principle, because they're watching Trump not wear a mask when people behind him are all in masks. And these things do matter. I think it's what we all talk about all day long. Because Trump's base is so devoted, and because the U.S. Population right now is so deeply divided, and I will say, full disclaimer, I'm an extremely conservative person. I was raised Republican. But because of how embedded Americans are and against one another, I think that come election day, it might not come down to something as mathematical as saying the unemployment rate has increased dramatically, so we're going to vote you out of office. And I think from the perspective of a lot of Democrats, they're concerned that Joe Biden finds and actually Joe Biden has said it, that he finds a presidential candidate who could be president because he is so old. So these are just the facts of life. And I certainly think that if there was a different presidential candidate on the other side, that this question would be much more viable. But unemployment rate spiking or not, I truly cannot predict the outcome of the upcoming presidential election.
The next question is from Layla, who's reading biochemistry at Oxford. She asks, do you think the crisis will prompt better quality research or just more data?
This is kind of an emotional question. I think that I'm in New York about every 3 weeks for media surrounding central banking events. So I'm many close friends in New York, many close friends in Boston. Many people have lost their lives. I've personally been involved in fundraising for personal protection equipment. And I think that because this has hit so close to home, that every country in the world will make sure that that research is improved and that we know and learn more about what's happened. Again, Hong Kong, Singapore, South Korea, these countries have done an extraordinarily wonderful job at confronting this corona crisis because they've been through it before, they've been scarred by it, and they have now better mechanisms by which to react to these types of health type crises. So I think that this has been a slap in the face. This is a huge wake up call that says you have to have your own research. You have to have your own access to personal protective equipment. You cannot be reliant on any country that that is a frenemy as opposed to a true ally when it comes to something as precious as the loss of human life. And reading just this morning things, headlines such as these Brazilian nurses are dying in droves because they don't have the equipment to protect themselves. I think this is and will be and should be a wake-up call for the world to put more into medical research and put more into building out a much more secure supply chain for pharmaceuticals and personal protective equipment.
Thank you. The next question we have is from George, who's doing engineering at MIT. And he asks, in your view, to what extent will working from home be a lasting impact of this crisis?
Look, you've got Twitter, you've got Google. One company after another is coming out and saying you're going to be able to work from home permanently. I think that there's going to be a downside to this, and that is that companies now have these massive spreadsheets, and they know exactly who their most productive workers are, because now you can quantify it. There's no more FaceTime at the office. They can actually look and say, this is employee XYZ, this is employee 1, 2, 3, and they are producing the most in an environment where they potentially have, 4 kids homeschooling on different curricula like I do. So they're going to be able to cherry pick as the drawn out economic downturn persists, companies are going to be able to cherry pick the best workers because they're going to have seen what they produce in the worst working environment possible. And separately, I think that you're going to have, it will be driven in part by cost cutting and the need to shore up profits for companies. But separately, I think that you'll have a long-term drag on commercial real estate prices because there won't be as much of an assumption that you must be in an office environment. Obviously, this does not apply to all industries. You can't have remote you can't have remote laboratories. There are certain things that have to be done in person. But we have learned, because this is something normally I would be at a podium in London and with jet lag doing, we have learned that through this crisis that we can be much more productive and we can be much more automated. And so this will expedite, unfortunately, for many workers worldwide, this will expedite the move to automation because it's been forced upon companies, and it will end up culling out the least productive of workers because, again, companies can approach this in a very scientific manner, if you will, going forward. So this will have a very lasting impact. Great question.
And a more cultural thread as well, Jack, who's reading physics at Imperial College, also asks, people have spoken about the crisis being a chance to reset our planet. Do you feel the crisis will have a long-term cultural impact due to its deep-seated economic factors?
Yes, I do. I think we are a global culture that came into this with some of the lowest poverty rates that we've seen in modern times. Here in the United States specifically, our social safety net was such that poverty was something that was really unheard of. And there have been, I've got the numbers right in front of me, there have been 40 some odd million employees who have applied for unemployment insurance. We know only of 25 or so, if I've got my figures correct, who've been approved for unemployment insurance, meaning there are millions of workers falling through the cracks with no form of income. And that is obviously something that our fiscal authorities have to address with more stimulus, because you cannot have that level of a humanitarian crisis in any country for that matter. But I'm speaking about the United States. Think about places like India, think about places like Brazil, and think of the lasting scars that this will produce. And yes, the cultural changes that will come about. I don't want to sound completely doom and gloom on this, however, because we have seen examples of how wonderful people can be to one another, and the charitable endeavors being undertaken right now do indeed bolster your faith in humanity. So clearly we're not talking about central banking anymore, but economic damage of this magnitude will definitely have a very, very long-lasting effect on society as we know it, on the culture as we know it.
Speaking of long-lasting impact, Melanie, reading Human Sciences at UCL, asks, do you think the amount of people that fly is actually going to be permanently reduced forever, or will the airline industry bounce back soon?
So it's funny because I'm one of these super frequent flyers. I was 150,000 miles last year, whatever it was. And for anybody who's flown recently, pre-COVID, we were getting more and more and more boxed in, and we had less space inside of airplanes. And that was how they managed to find profitability as an industry. Obviously, there were a lot of share buybacks here in the United States. That's a different story for a different day. Had they saved that cash cushion, they would be in a much better position right now. But I think that the idea of proximity is going to be seared into our minds for a very long time, and it will indeed change the way people approach air travel going forward because of the idea of safety, especially if COVID-19, as some scientists suggest, is something that's not going to go away anytime soon, or going to replicate the pattern that we saw with the 1918-1919 Spanish flu and come back in the fall, come back with colder weather, which truly remains to be seen. But even if there's no second wave, I do think that especially international air travel and people's willingness to be in very close quarters is going to be questioned. You've already seen a mass move from the city of New York out into the suburbs outside of New York City. So there's definitely going to be a backlash against density in all of its forms, including air travel.
The next question is from Olive Tunji, I hope I pronounced that right, studying law at Cambridge, who asks, just before COVID, everyone seemed to be waking up to the dangers of climate change. Will a potentially long-lasting recession now undermine the fight against this?
That is a real risk. Right now, every fiscal dollar of stimulus spent around the world is going to immediate needs. And if to the extent that climate change is somehow reclassified as being ancillary in nature, then that is going to be a risk that is run, is that the funding to provide for climate change is going to be pulled in the aftermath of this recession, especially if it's as prolonged as it possibly could be if we don't see a V-shaped global recovery. That is going to be a risk because budgets will be as curtailed as they are. And you're indeed right. There was a global movement. There was a waking up that preceded this.
Speaking of risk, Jamie, who is studying English at Oxford, asked a lot of pertinent questions. He asked, do you think the supply side aspect will recover in the energy market?
Well, I think energy will be forever transformed after this. I live in Texas, so we think we're going to lose 30 to 40% of the energy companies here just in this state, and the ramifications for employment are just awful. But I think the ability to pull so much energy out of the ground in the United States is not going to go away, even if it's not profitable as profitable as it once was. But I think that the idea of energy exports from the United States, and I hope I'm addressing your question, but I think the idea of energy exports from the United States, less reliance on OPEC, is going to forever improve the security of the supply chain specifically to the energy market. You won't have the threat of Putin turning off the natural gas lines in the middle of a cold winter. That simply won't exist anymore because there's such an abundance of natural gas that you can pop onto send it overseas. So
fascinating. Naveen, who's doing business at Oxford, asks, if fiscal and monetary policy is very high and doesn't result in runaway inflation and US debt is backed by the fourth phase, does this mean that the US can spend as much as it wants or needs?
I'm sorry, but your question didn't come out on the bottom of the screen, and I didn't hear the last part of it.
So I'll read it again. If fiscal and monetary policy is very high and doesn't result in runaway inflation and US debt is backed by the fourth phase, does this mean that the US can spend as much as it wants or needs?
Yes, it does. Yes, it does. That is the theory. That is what Jay Powell has said. That as long as if you've got interest rates at the zero bound and servicing the debt is minimized and minimal, then in theory we can just print to kingdom come. It upends history. I'm talking about long history, but in theory, yes, you can just keep printing.
So we have one more question from Janet, who's at Cambridge, who asks, what is your hope for capitalism post-COVID-19? Do you see reduced inequality?
Two separate questions. What the Federal Reserve has done here has put a dagger through the heart of capitalism. It's with good reason that that the bankruptcy code stands, even though it is sourced in the Napoleonic Code. The idea of bankruptcy is that you don't get rid of all of your employees, but that you go through a restructuring process that wipes out unsecured debt holders and shareholders. That absolutely has to be the way that capitalism is upheld. If you have the Federal Reserve step in and prevent this creative destruction, as Shimter described it, from occurring, then you're going to kill capitalism. It really is as simple as that. You have to take the least efficient players out of the system in order to make room, once recovery hits, for innovation, for new players, for new creators of jobs to come in. If you keep the dead wood, if you keep the zombies alive by keeping the junk bond market open, then you're going to paralyze growth long term. And it goes to why we've had just come out of the longest expansion in US history, and yet it was the weakest. And that is because you take away the economy's ability to regenerate itself if you prevent insolvent players from going truly through restructuring, which wipes out shareholders. In doing so, which Federal Reserve policy has done, you continue to reward. I would point out that the private equity industry spent $3 billion lobbying the US Congress in the first quarter alone. They ended up being successful because now there's a Main Street lending program that applies to their portfolio companies. So the rich are going to be, they're going to be covered. As Jay Powell said, he wants to make them whole. He didn't put rich in front of it, but he is talking about companies. So if you continue to ensure that risk-taking has no consequences, that you make sure that the wealthy are wealthier, that you keep companies in business that cannot employ more people because they don't have good business models and they're not going to organically grow, they're just going to subsist and pay shareholders, then you're not going to make room for the next crop of job creation. So you're going to keep the rich richer, and you're going to stunt the creation of jobs for people to come up and provide opportunities, and you're going to continue to widen that inequality divide, which leads to basically society breaking down.
John, studying law at Cambridge, asks, do you think national governments ought to tighten their regulatory landscapes amidst the current fears that Chinese companies are buying up distressed assets in light of COVID-19?
There's no myth about the intellectual property theft. This is not a weapons of mass destruction type of debate. There's no gray area. We know that it has occurred, past tense. We know that there are dangers of future forms of espionage out of China. To fall back on a cliche, and I apologize, a tiger does not change its stripes. So should there be more regulatory scrutiny? I would say that the answer is yes, absolutely yes.
On a perhaps lighter note, Michelle, studying modern languages, asks at Oxford, asks, what reading recommendations do you have for us in these times, besides your own book, of course? We've all got a lot more free time these days, so I do appreciate it.
Well, summer is coming, so I'll just throw one out there that is so much fun. It's called The Destroyers. Goldfinch is another one of my favorite novels. As far as inspiration for my career, the absolute must-read book is The Lords of Finance. And what's perhaps most fascinating about The Lords of Finance is that it brings in not just the history of the founding of the central bank in the United States, but it brings in the roles that the Banque de France and the Bank of England and can't think of what the German central bank was called back when, but it brings in the roles that they all played and sets up a great background of where the gold standard was, how it got destroyed. The parallels to what's happening in economies globally are just uncanny. It is a fantastic read, The Lords of Finance. But again, if you need some virtual beach time reading, read Goldfinch, even though it's a bit dark. Read The Destroyers, based on a Greek island. Two great, fun reads. And thank you, Michelle, for asking a light question.
Thank you so much.
Yeah, seems like a brilliant question to end on, a light note. Exactly. Danielle, thank you so much for your time. You've been brilliant. I know we've run slightly over, so I'm very, very thankful to you for that. Thank you to everyone for joining and for all your amazing questions. Thanks, guys. We'll see you soon.
Be safe, everybody.